Hey everyone, welcome back to Corporate Decoder. Today DPZ just filed an 8K announcing their first quarter 2026 financial results, and I'm seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. While Domino's announced store growth, they're saying store sales missed expectations, which is a huge deal for a restaurant chain. This filing is a current report, meaning Domino's Pizza Incorporated is letting us know about some important stuff that just happened. The main reason for this filing is to share their first quarter financial results. Keep in mind, these are preliminary numbers for the quarter ending in March of 2026. Domino's Pizza Incorporated, as you know them by their ticker DPZ, is traded on the Nasdaq stock market LLC. It is a pretty big name in the pizza world. The big news here is the release of their first quarter financial results. They put out a press release on the 27th of April 2026 to share these numbers. Now, the filing itself doesn't contain all the juicy financial details. It basically just points us to that press release and says, go read that for the good stuff. And that is exactly what we're going to do. So, what did Domino's reveal in their earnings press release? Well, according to the headlines we've seen, they did add over 180 net stores worldwide. That is positive expansion, showing they are growing their footprint. They also authorized a new buyback program, planning to repurchase up to $1 billion worth of their own stock. This can sometimes be a good sign, suggesting management believes the stock is undervalued, however. And this is the crucial part. Domino's falls after same-store sales miss expectations. This is a big deal for any restaurant chain. Same-store sales or comparable store sales are key because they measure the performance of existing stores, not just new ones. If existing stores aren't selling more pizza, it means they're not attracting more customers or getting them to spend more. Another headline also notes that their earnings per S-Hair or EPs slipped 4.6%. While growth in new stores is good, the performance of their core business, the existing restaurants, seems to be faltering. Think of it like this: if you own a bunch of rental properties, adding new ones is great. But if the rent from your existing properties isn't going up or is even going down, that is a serious concern. For Domino's, this miss on same-store sales is a definite red flag. When we look at the context here, Domino's Pizza Incorporated is a consumer cyclical company in the restaurant sector with a market cap of about $12.4 billion. A P/E ratio of about 20.9 is fairly standard for a company of this nature. Major institutional holders like Vanguard Group and Berkshire Hathaway Inc. continue to have large stakes, suggesting they see long-term value. But long-term value can be jeopardized if the short-term operational performance isn't there. While the actual financial tables aren't directly in this 8K filing, the accompanying press release is where the details lie. Looking at what the street is reporting based on that release, the underlying trend points to a struggle in same-store sales growth. This is typically where a company like Domino's makes its money. They've obviously got a massive operation. With around 6,200 employees, expanding to over 180 new locations is a significant undertaking and investment. But if those new locations don't have a strong foundation in what comparable stores are doing, then that expansion could be masking underlying issues in customer demand or operational efficiency at their established restaurants. The market's reaction to this news was immediate. The headline, "Domino's Pizza Falls After Same, Store Sales Miss Expectations," tells the story. Investors are clearly putting more weight on the disappointing comparable store sales than on the new store openings or the share buyback authorization. This is understandable, as a business needs to demonstrate that its current operations are healthy and growing. A comparable store sales miss can signal that competitors are gaining market share, that there are issues with product offerings, or that consumers are cutting back on discretionary spending. Looking at the bigger picture, Domino's has built its empire on convenience and consistency. When that consistency falters in terms of sales growth at their existing locations, it raises questions about their core strategy. The share buyback program is a financial tool that can support the stock price, but it doesn't fix a fundamental problem of declining or stagnant sales within their established stores. It is like putting a fancy new coat of paint on a house that has foundation issues. In essence, Domino's is signaling growth through expansion, but the engine of that growth, its existing stores, appears to be sputtering based on this report and the market's reaction. While they are adding stores and buying back shares, the core health of their comparable store sales is what I am watching very closely. The risk I am watching is whether this miss in same store sales is a temporary blip or the start of a longer-term trend that could impact future growth and profitability. What I am actually looking for is sustained, positive comparable store sales growth that indicates strong customer demand for their core offerings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe for more, and check out our Discord community in the description.